Good morning, and thanks for joining me to talk about Chalice and the Gonville project. This is the leading palladium, nickel and copper development project in the Western world. Thanks to the Future Facing team for having us back here for the third year in a row. I'm going to take you through the latest developments on the project, our new exploration targets, and what else the company has been up to. So who is Chalice Mining, and why should you be interested in the company? We have the 100% owned Gonville project, located 70 kilometres outside of Perth in Western Australia. Gonville has 17 million ounces of PGEs, most of which is palladium. It has nearly 1 million tonnes of nickel and over 500,000 tonnes of copper. This is a large resource on anyone's measure, and the mineralisation all starts at surface. It was discovered in 2020. We're in the middle of a pre-feasibility study, and we started the approvals process in March of last year. We have an MOU with Mitsubishi. We work closely with them on trying to find the best outcomes for the project. Mitsubishi are a first choice partner to have on a project like Gonville, and they're well known as a foundation member on a number of the biggest and best mining projects around the world. Both palladium and nickel are trading at cyclical lows. The Chalice stock trades with a very strong correlation to both of those commodities. And so right now, the Chalice share price is trading with an enterprise value of $17 per resource ounce. That is very, very cheap for a precious metal of in-ground resource. We see this as a very compelling counter-cyclical investment opportunity, and very well suited to a macro Trump 2.0 environment. The balance sheet is strong. We have $90 million in cash and listed investment. There is no debt. We are very prudent with our expenditure, and this balance sheet sees us well funded right through to a targeted FID in 2027. So Chalice is listed on the ASX. It's part of the ASX 300 and it has a strong institutional shareholder base. The last 18 months have been a challenging period for our shareholders, but the register has been really stable throughout that time. Our shareholders take a long-term view because they see the compelling leverage that the project characteristics have to a turnaround from these stubborn multi-year lows. And as history has always shown us, commodities do always recover. In February of this year, we had a big breakthrough on our MET release and our flow sheet. On the back of that announcement, the stock jumped 30%. Our trading volumes jumped about 80%. We went from about 3 million shares a day to about 5 million shares a day. So liquidity is strong. This was a real reset for the project, which we'll talk about a little bit more later on, and it was well covered by the sell side as well. So I mentioned that Chalice has a strong correlation to the palladium price. So why would you want exposure to palladium, and why do we think that this precious metal is at a cyclical low? So think of palladium as a very niche market. There's only about 9 million ounces produced and recycled every year. This is in comparison to gold, which has about 10 times that amount. So this niche market is very susceptible to sharp changes in demand and sharp changes in supply. And the drop-off in the spot price since 2022 has largely been driven by the sentiment around growth in battery electric vehicle sales, and also this destocking phase where above-ground stockpiles are being run down. But the sales of battery electric vehicles has hit a plateau, and market share is not moving above 20%, and this destocking phase is starting to run out. We're hearing that these stockpiles are just about finished. So each time the spot price in US dollar terms hits about $900 to $950 an ounce, it hits that threshold and bounces back. So it's almost like it's hit this natural floor. So when you look at the palladium price and the palladium market, your downside is very much limited. On the demand side, 85% of palladium goes into catalytic converters. Catalytic converters are used in petrol engine vehicles and hybrid electric vehicles. If you go back 3 to 4 years, all the sentiment was around that we'll all be driving battery electric vehicles. There's no catalytic converter in a battery electric vehicle. And so the long-term demand forecast of palladium was that it was going down to zero. But if you fast forward to today, the data is telling a vastly different story. Yes, we did have strong growth rates in battery electric vehicle sales when governments were providing strong incentives to buy these new vehicles. But as those incentives were removed, the battery electric vehicle market share sales plateaued. It plateaued, and then we saw Chinese manufactured battery electric vehicles start to hit the market, and we saw another spike in growth. But in the last 6 to 8 months, battery electric vehicle market share has plateaued at 20%. Why is that? Consumers are going back to their petrol engine vehicles or buying hybrid vehicles because of higher than expected running cost, range anxiety, and just insufficient charging infrastructure in most global cities. Western manufacturers are adjusting to these consumer preferences. They're scaling back their BEV production and scaling up their hybrid production. Surprisingly, and perhaps this is the opportunity for investors, is that the growth story in hybrid electric vehicle sales is still not yet reflected in the consensus palladium demand forecasts. On the supply side, 85% of palladium comes from Russia and South Africa. The mines in these countries are decades old, they're deep, with all of the best ore mined many, many years ago. At these current spot prices, about 30 to 40% of the sector is currently losing money. So what happens when mines are losing money? Companies move towards survival mode and they stop investing capital in these mines to at least maintain production, and they most definitely do not invest capital to increase production. In reality, what's happening with these mines is they're starting to curtail the unprofitable ounces, protect their cash flow and protect their balance sheet. And that was best highlighted by Sibanye-Stillwater halving their production at the Stillwater mine in Montana for the calendar year of 2025. Off the back of that announcement, the palladium price moved about 20% in a matter of weeks, and the Chalice share price moved about 80% in the same time. And this demonstrated the leverage or the susceptibility that this palladium market has to supply shocks, and also the leverage that Chalice has to these movements. So moving more to the Gonville project in more detail, Gonville has scale, long life, and is low cost. It has a revenue split of about 50% palladium, 20% nickel, and 20% copper. The remaining 10% comes from gold, platinum, and cobalt. So it is largely a palladium exposure with good byproduct credits from the other metals. And that's what allows it to be predicted to be one of the lowest cost PGE producers in the Western world. It's 70 kilometres outside of Perth in a low-risk jurisdiction surrounded by good infrastructure. We started the approvals process in March of last year, and that approvals process has been largely de-risked by the acquisition of 22 square kilometres of farmland surrounding the project. It's really important to emphasise that the whole mining development envelope of the Gonville project is on Chalice farmland, Chalice-owned farmland only. In Australia, there's a bit of a rule of thumb that if you can go from first discovery to first production, or discovery to first production in 10 years, then that is an excellent result. We just celebrated our 5-year anniversary of the Gonville discovery, and we are well on track to meet that timeline. In the first 5 years, we've drilled out the resource, we've bought the farmland, we've put the right team together to go and build this project, and most significantly, we've now developed a simple flow sheet which has transformed this project from being what was previously considered a speculative development play into an actual development play with a clear pathway to cash flow. In the next 5 years, we're going to lock in the infrastructure corridors, we're going to secure all our necessary approvals and our offtake agreements, we'll finalise our financing and all the way on the pathway to a final investment decision in 2027. So the flow sheet, and this was the key area of the breakthrough that I mentioned back in the middle of February. This is a simple stock standard mineral processing flow sheet that has been built routinely over the last 100 years. Previously, it was thought that our nickel grade was too low to upgrade into a saleable nickel concentrate. And so that was forcing us down a path of further downstream processing using a hydromet facility. The hydromet facility added CapEx, it added OpEx, and it added complexity. Recognising that we needed a more simple operation that was more suited to a low price environment, our metallurgists kept tapping into new expertise, adjusting the various factors in the flotation circuit, like a reagent mix, the grind size, the froth height, amongst a few others. And then over 600 flotation tests were conducted, and finally we cracked the code. So we now have this flow sheet that can be applied across the entire resource that produces a saleable copper concentrate, a saleable nickel concentrate, and a PGM doré bar. This pretty much looks like a typical gold processing plant. You can see the recoveries there just below the flow sheet, and most notable about these recoveries in those early years of the project, when you need to pay back that capital, our recoveries are much higher. They're much higher because they're driven by the high grade at the top of the resource, and then over time those recoveries will slightly reduce in line with the grade profile. So in summary, what did this breakthrough give us? Well, it gave us reduced capital costs due to the removal of the hydromet process, reduced operating costs because of the removal of the hydromet process and lower reagent consumption, and just a more simple, lower risk type operation overall using proven industry standard technology. Yes, we'll see slightly lower recoveries and slightly lower payabilities, but that is largely offset by the other benefits, and overall the project margins are much better. This is a project that is built for all seasons, and when you look at the cost curve, this is based off our 2023 scoping study, and you can see that we're well entrenched in the second quartile of that cost curve. With the improvements that we've just made in the project, there's now downward pressure on that all-in sustaining cost, so we'll move even further down with better project margins. Even today, while 30 to 40% of the sector is losing money, if we're in business right now, we'd still be making good margins. So moving on to the second pillar of Chalice, we've just been talking about the Gonville project, but then there's also 8,000 square kilometres of unexplored land in the West Yilgarn. And the Chalice DNA has been very much to be attracted to large land-scale packages in frontier areas, and that's what attracted us to the West Yilgarn in the first place. The West Yilgarn was previously mapped as barren granite with no outcropping mineralised geology. Our geologists challenged that theory, went and did some bottom-up exploration geology involving some mapping and soil sampling, and that's what led to the discovery of Gonville. We're now using those same techniques to go and explore the rest of the 8,000 square kilometres of which we own, and we've got the first mover advantage in this new area. The focus now is on gold or copper gold type discoveries, and we're very excited by the geology up at the Barra Barra project. The geology up at the Barra Barra project is your typical greenstone geology that you see in the southwest, and this is the type of geology that hosts large-scale gold discoveries like the Newmont-owned Boddington, which has 40 million ounces. We did our first round of air core drilling at Research West and Warspite. They're the two targets at Barra Barra. We confirmed the thesis that it is greenstone geology. We went back for a second round and just finished that last week, and we're looking forward to getting those results in 3 to 4 weeks' time. These two targets are surrounded by a radius of 100 kilometres. So if we just get one economic hit, we're going to open up a whole new belt in an area that is pretty much owned all by Chalice. I'm about to get the wind up, so I'll just hit the high notes from here. We've got a PFS which is due in the September quarter of this year. Post the PFS, we will get started on our offtake agreements and our project finance, and in parallel we'll continue on with the approvals process. And so in summary, if you're a believer in the slowing of BEV sales and a continued recovery of the palladium price, have a look at ways to get exposure to this. There are limited ways to play this trade. Gonville has scale, long life and is low cost. It is clearly the leading investment opportunity to get your best leverage.